Okay, let's go ahead and get started. Thank you everybody for joining us. This is Charles Roberts. I'm the president of Your Castle and a guy who's completely obsessed by Denver real estate trends. So I talk about this stuff in my sleep, but fortunately I'm awake and I'm talking about it, and I can't wait to talk about this with you. Got lots of new data we just updated for the fourth quarter of 2017. So the only thing I ask of you is if you have questions, please shout them out. Type them in. We are monitoring questions. We love questions. The harder the better. It's really, really interesting when I get some of your thoughts and your opinions on what's going on out there. I'll give you mine. For those that don't know me, been an investor for 20 years. I'm the president of Your Castle and Shorewood Real Estate. I own an investment portfolio of properties, and I'm an active agent. So still out there hunting for properties, and all of this stuff is really important to me, and I'm sure it's really important to you, or you wouldn't be here. So without further ado, let us jump in and look at our market. So I like to start with this slide here. I know it's a really busy slide, but bear with me for a moment, because what I like to talk about here is to say, well, let's say you're an agent. People ask you all the time, how's the market? Or let's say you're an investor. You want to know how the market is, and many of you are going to be both. And we broke it down into 6 metrics, and I'll open this up a little bit so you can see a bit better. And these are the metrics that we think are important, that you should be thinking about as an investor or a buyer or a seller, or if you're going to do a 1031, or if you're going to rent the rest of your life, whatever you're going to do. And you agents basically have to cater to the investors and the people who are looking to buy and sell property. And these are what we think we should be talking about. So let's start with average home price. What you see right here is that these are the average home prices going back a bunch of quarters. And I'm not going to get into the details because honestly, I'm a sort of forest, not trees kind of guy. I want you to see the big picture. And the big picture is prices have been going up for this period of time. And the even bigger picture that I'm going to show you in a slide or two is prices have been going up for 7, 8 years. We are in the middle of a long upturn. So average home prices are going up. Why are they going up? Because we have more demand than supply. So here is the supply, the months of inventory. So what you will see here, for example, in this quarter, the months of inventory was 0.9, now it's 0.8. What's important to understand, in a balanced market, it's about 4 to 6 months of inventory. That means at the pace at which properties are selling in a particular market, if no new properties came on the market, they would sell out in that period of time. 4 to 6 months is what we consider a balanced market. This is 0.8 months. That just means it is on fire. And I'm telling you, everything you're going to hear from me for the next hour is just going to be saying the same thing over and over again. People moving into Denver, not enough building, very tight supply, supply and demand, economics 101. They all run together. Showings per active listing. I'm going to show you a great graph on that in a couple of slides to essentially show you our way of looking at this metric to say, once again, we have more buyers, we have fewer sellers, that's pushing prices up. Under contracts is a really interesting situation. If you look at a year ago, and those of you who were doing this a year ago know how tight the market was then, we had 3,139 properties on the market under contract. At this point, this snapshot was 2,524. What am I saying here? What I'm saying is we have so few properties in the market, we can't get anything under contract. So let me tell you, if you're an agent, if you're someone who owns a 100-person agency, you might be suffering a little bit. At least the market says you're suffering. We have more agents in the business, and we have literally fewer closings. Once again, there's no inventory. How do you have closings when there's no inventory? That's what we're seeing. The numbers sold, same thing. We have fewer sales than we have in the past. We got lots of buyers, got nothing for them to buy. And then this is the big one here, the inventory. As tight as it was a year ago, we actually have less inventory on the market. So now I'm going to show you a bunch of really pretty graphs with colors and neat pictures and stuff. This is the word version of that. And what you want to do, say, as an agent, when someone says, how's the market, you don't want to say it's great. You don't want to say something silly. I think you want to say, well, it depends what you're looking to do. Let's talk about it and give some details. And that's why you're spending time with us today. Once again, any questions, just type them into the question box and we will see them immediately and jump on them. And we'll have lots of fun with that. Let's go to the next slide. Make it a little bit smaller here. So this right here is the price of homes, single-family homes, not condos or townhomes, since 1971. And what you see is that we have long periods where prices go up, then they don't go up. Then they go up, then they crash, and then they go up. So right now, at the snapshot that this was taken in January of 2018, the average home price was $477,000. And as you can see, prices bottomed out around 2009 and have essentially been going up ever since. This curve right here is about 6%. Home prices in Denver have gone up about 6% over time. About 2% of that can actually be related simply to square footage. Homes have gotten bigger over this period of time. And then you could argue that about 4% is inflation. Interestingly enough, that's pretty much what's behind this. What I want to show you, though, is that a lot of the questions and a lot of the thoughts you'll have is, wow, Denver prices are so high. What goes up must come down. Is that right? I don't really know if it's right. All I can tell you is that, for example, during this 16-year period, I'm sure not a day went by when someone didn't say exactly that. They said at year 7, well, right here, they said, well, I mean, this must be the peak, right? Prices have been going up for 7, 8 years. And then they missed it by 9 years. I'm certainly not saying it's going to do this for the next 9 years. What I'm going to say is, truly, unless somebody is selling you something, we don't know. But what we do is we look at data and we say our best inference is, lots of people moving to Denver, very little supply of housing on the market. I personally believe prices are going to go up. I'm not a market timer. I've been an investor for 20 years, but I did buy 6 additional properties between 1 and 2 years ago. Over the course of the year, I bought 6 condos and townhomes around Denver, and then I bought another one about 3 weeks ago, just a little condo that made a lot of sense. So does that mean I know something you don't know? Not really. I mean, I spend probably more time thinking about this than you do, but I don't know what's going to happen. But what it does certainly mean is I don't think the market's about to crash. I can tell you, if I thought the market was going to crash, if there was some reason to believe that, I wouldn't be advising my investors to buy, and I certainly wouldn't buy myself. So I guess do as they say, not as they do, or do as they do, not as they say, whatever. I'm buying property because I honestly think with the limited supply, prices are going to continue to go up. Let's look at it for condos and townhomes. What you'll see is it's pretty similar. That's single-family homes. This is condos and townhomes. They go up, they go down, they go up, they go down, and condos and townhomes have skyrocketed, actually gone up faster in the last 7 years in price than homes. That was something that nobody had predicted 7 years ago. Part of that may have been the construction defects issue where most attached properties were rented into a great rental market because the builders said, well, we don't want to get sued, so we'll just rent it since it's a great rental market. But all in, it's the same basic numbers. Lots and lots of demand for these and very little supply. So prices have been going up real strong. And once again, jump in if you have any questions. So this right here is one of my favorite slides. What's going on here is this. We're looking at 2008 all the way up to present day, and we're looking at 2 different numbers. This is the active homes, condos, and townhomes, the active listings on the MLS. And this right here, the dotted line, are the solds. And it is the perfect picture's worth 1,000 words. If you're an agent and someone says, how's the market? I might start with this slide right here because it tells people everything they need to know about the market. If you were in the business in 2008, 2009, you know what a downturn looked like. You know what a buyer's market looked like. It looked like you have 25,000 properties in the market and you're selling 4,000 a month. Really tough. Why? Well, it's tough if you're a seller. It was great when we were buyers and our clients were buying tons of properties then, those who had the guts to buy, because it was a scary time to buy with everything happening in the economy. But people were scared. They weren't buying, they were selling. And this right here was the perfect buyer's market in retrospect. What you see over time is the market begins to correct, and it did. 11 and 12, and then you get down here to 13, 12 and 13 when the market started to get really hot for sellers. And what you see here is just an incredible period of time. We're now 5+ years into literally having periods of time where we have about the same number of listings on the market as we have sales. And by the way, that's exactly what we had in January. Incredibly tight market. Couple things to get from this. One is that it's so important to understand perspective. I'm going to say perspective about 100 times. Someone reads an article in the Wall Street Journal and suddenly they think they know what the market's going to do and it's going to change tomorrow. And that's just not how it works. You see how this took years to change? And then I and everybody else didn't think that this would take years, that we would actually stay in this dynamic for years, but we did. My best guess is that someday, and don't ask me when, this is going to change, and it's probably going to change like this. People like to talk about bubbles, they like to talk about crashes. I just don't see it happening. That's my best guess. So, got some questions, which is awesome. Thanks for that. Matt, thanks for joining us. What's the average appreciation for condos over the same period? So it's about 5.96%. So over that 1971 to present day, homes are at about 6.3%, and condos, it's funny, we used to quote 5.9% a few years ago. I'm leaning towards 6 because they've skyrocketed so much in the last couple of years. Yeah, call it about 6. So what's so interesting is that it's about the same. Now you have to understand, there's a million things going into these numbers, so be careful with statistics, lies, damn lies, and you know what. But the big picture is condos and townhomes over the last 45 years have actually appreciated in value about the same as single-family homes over time, which, by the way, is a big surprise to everybody. So you got that one now. Great question. Got a question from Mike. Thanks for joining us. Can you provide the slides at the end of the presentation? Mike, send me an email. And yeah, I'll get you what I can. And then Matt, thanks. Great, you're very welcome. So yes, good questions. Let's keep going. So this right here is showing trends. This is a metric that Lon Welsh put together back in 2010, and it was a really brilliant way of looking at the numbers. And I love talking about this one, which is why I included it today, because it just gave a perspective that I'd never seen before. And as far as I know, no one had ever looked at before. What we look at is the average number of showings per active listing per month. And these are your castle listings, but we're a pretty big company with 500 people, so it's pretty representative of the meaty part of the market. So what we're saying here, for example, in January of 2010, was there were about 6 or so showings per listing per month. And what does that mean? It means absolutely nothing, because it has to be taken in context to the next month and the next year. So what it turns out was 2010 was still in the downturn, and we had 5, 6, 7 peaking at 10 and then down to 5, so even a little below 5. Call it an average of, say, about 6 showings per listing per month. 2010 was the breakout year, and one of the reasons we saw it coming was we said, wow, we just went from 6 to about 12. And what that meant was one of two things. Either there were more showings, more buyers, and or there were fewer listings, and you basically do the math, showings divided by listings, and you get a higher number. And that's the brilliance of this, is this shows the demand per listing. So what we have seen over time is everything, that the demand has gone up, more people looking, and the supply has gone down, and the simple math raises this number. So in 2012, we actually started staffing up right here because we knew we were going to have more closings because of this demand. So let's jump to 2015. Wow. You see, we went from 12 to over 20 in January. Incredible demand. And then 2016 was this. We had this bizarre number here that we have looked at 50 times, and all I can tell you is it's true. We went above 35. We don't know why, but it was a bit of a little bubble there. But we came right back down to where we were. And now let's look at 2017. What you'll see is that 2017 looks a lot like 2016, a lot like 2015. And if 14 and 13 were here, they look similar. And here's where we ended up. This is the latest number we have. We actually had a record for 2017 Decembers. What does this mean? It simply adds more fuel to the fire and more credibility and credence to say, yes, this is a very, very, very strong market. We have lots of people looking at properties, and we have very few listings. So what I've been hearing, I mean, not a day goes by when one of my agents or a client or someone says, hey, you know, I think the market's peaking. You know what? I just went out and I looked at a property and there weren't 14 people there. And we sort of chuckle about that because it's like, okay, that's kind of short-term data. It's a bit anecdotal. I don't want to sound too, pinheadish, but are you sure the market's peaking? But I swear to God, if you're in this industry, you hear this all the time. My response is, okay, it's fine. I'm not going to try to convince you of anything. I'm happy to look at the data and at least have the data to support you. But right here, I was hearing a lot of it in September and October from my own agents saying that they felt the market was weakening. And I don't think the market's weakening. That's the bottom line. Anybody wants to put a question in or argue with it, I'll argue with you. And if you can convince me, believe me, I'll buy you a big cup of coffee. If you can tell me something that I don't understand, that'll just make me better at what I do, and I want to hear it. But this is what I'm thinking. Michelle Towers, how are you? Great. Let's see what you got here for a question. If the best time to buy is later in the year, but the best time to sell is in the spring, how do you respond to someone who has a house to sell before they can buy a new home concerning when is the best time to make a move?
Yeah, Michelle, what you do is you buy a temporary house to live in. So I'm going to be listing my house as I'm moving at the end of this week or early next week. I'm going to move into temp housing, and then I'm going to buy a house, or actually in this case, I'm building one in the fall. So if you actually want to be optimal, you take on a little bit of inconvenience.
So that was Lon Welsh, who's sitting here just kind of playing around with us, and I wanted him to jump in because he's actually going right through this. Clearly, most people aren't going to do this. So Michelle, you give them options. The option are you be like Lon, obsess over it, and do what financially is going to be the right thing for him. He's literally under contract right now, right?
Well, it was an unusual situation that I was able to move my parents into a fix and flip. I just finalized all the rehab work on, and then I wanted to buy another rental anyway, so I'm going to move into the rental and eat my own dog food for a while. So it was very convenient for me to do it, as it turned out.
Yeah, finger quotes on the convenient thing. So that would be one option. And then the other is to say, what you say to your buyers and sellers, whichever they are, is here are your choices. Now you've got to decide what you want to do. And there may be an optimal choice for you. Lon just explained what's his optimal choice is to go and suffer through the inconvenience, if you will, to actually, get the best return. If they want all the money with no inconvenience, then I would say move on to a different client. They're not being realistic. All you can do is counsel them, because what you're saying does have some backing to it, is that there's a good time to sell and a good time to buy. At the end of the day, I tell my people, unless you are, what's the word? Well, not crazy, but one step short of crazy, you might have to give a little bit if you want your life to be under control. And that's, by the way, Michelle, you may have heard me say this before, but that's why agents aren't going away, because a computer can't answer this. A computer will spit the data out. People need people like you who care about them, who want to get the right answers for them to help them make the decisions. And by the way, if your folks want to talk to Lon or me, we'd be happy to input into the conversation. Always happy to do that. Great question. Thank you. So let's move down, talk about this slide right here. Looking at the historical context, this is also a great slide that Lon put together years ago, because believe it or not, it was like 2013 when we started hearing from our agents and the clients of our agents saying, hey, is a bubble about to happen? The market's been going up for 18 months. We're at the all-time high. This can't, stay like that. And our answer then was similar to how it is, what it is now, is, well, we don't know, but let's at least have something interesting to talk about and see where it takes us. So what we looked at was the relationship between the population of Metro Denver and the growth in home sales. And what we say, this little dotted line here, is that as the population grows, one would expect to have something like a corresponding increase in the number of sales. So let's say you have a town that has 10 properties in it. They're going to have way few sales than New York City, right? But if that 10 goes to 5 million, then they're going to have a lot of sales. Why does this purple line go up? Well, because people move to Denver, which, by the way, is a lot of the reasons why I own property here, because people want to move to Denver, and I think it's a pretty safe market to own properties. So what we would say, for example, is, say in 1979, Denver Metro had a population of 1.5 million. We would have expected to have about 20,000 sales. That's what's going on here. So let's look at the reality, because, of course, the reality is never what the line says, never what the Excel spreadsheet says. The reality is, for example, in the 70s, we had a boom. Lots of oil money, lots of great stuff. Dallas was on television, that kind of stuff. And we were selling lots and lots of properties. We only had a market that really should have supported about 20,000 sales a year. It's 20,000 transactions. But man, look at that. we sold 25, 26, 27,000. Well, we overshot ourselves and we got into a recession in Denver as well as the rest of the country in the 80s. And what happens? People don't buy during a recession. Well, that's what happens. So the number of sales really cratered down to, in 1982, incredibly high interest rates, terrible time, very, very difficult to buy. We should have sold, given our population, say 21,000, we sold more like, say, 13,000. And by the way, it doesn't change weekly or monthly. These things take a long time to change. As you see, we started to work out of it. And then in the 90s, early 90s, our market started to turn. And if you guys were here, 91 was kind of the inflection point, 91, 92, when prices started to go up. And then you have this period of time, about 10 years, where you have roughly the number of sales you would expect to have with this growing population. Okay, so here's a bubble. That is what a bubble looks like. You expect to sell, to have about 37,000 transactions. You have 50,000 transactions. I'm telling you, if that happens again, I will be using the B word. I'll be saying that looks like a bubble to me right there. Well, we bubbled and we crashed. And that is the definition of a bubble and a crash. And then we went down and down and down. We get to 2010. We should have in our market over 40,000 sales. What do we have? Close to 30,000. So if you're listening, what you're hearing is things move, things happen, things change. Over time, they do change. And as you saw in the last couple of slides, it was 2012 or so when we really started to see things change. So here's where I'm going with this. This is the last couple of years, and this is 2017. What I am seeing, this is the latest numbers, 2017, is that, in my opinion, strangely enough, this looks very normal. This doesn't look normal. This doesn't look normal. The 80s doesn't look normal. Surprisingly, though, the one thing you never hear from anybody in real estate is, yeah, everything's kind of normal. I'm not saying everything's normal, but I am saying this is a pretty important metric for someone like me. And I actually think we're selling about the number of properties that we would expect to sell in a market in an MSA of 3.1 million people. So does this mean absolutely positively it's not a bubble? No, none of this means that. It just adds data to me to say, yeah, I'll buy some more properties, and my investors will buy some more properties. They'll long-term buy and hold people, and they'll make a lot of money. Got a question from Tony. Can we get a copy of this recording, please? The answer is yes. We did check the button that says record. Channing's here with me. And Channing, do you want to just throw out exactly how they get it? Do you know?
We'll send it to you in email.
So if you registered for this webinar, you'll get an automatic email saying, okay, yep, that's how it works. You'll get an email. And then, yeah, of course, we want you to have the availability to be in your shorts at 2 in the morning and listen to my pleasant voice talk about Denver real estate. So thank you for asking that. Should have clarified that. Any more questions? Keep on coming. Let us move down here to...
There's another question. Oh,
another question. Yeah, Matt. How did you come to the correlation of expected sales transactions to populations? Yeah, there was a standard. That's a good question. There was a standard of, now I'm guessing now, but is it people moved every 7 or 8 years? And that's actually gone up. It's now more like every 10 years. So we use something in the middle there, and I can get that. I know that Lon had figured that one out, but there was some sort of normal data for how often population moves. And if you need more on that, let me know. Send me an email. It's a good question. Alrighty, let's get down to this, affordability. Another one of my favorite topics, because the other thing that everybody says is that Denver homes are unaffordable. It's just one of those sort of de rigueur, you have to say it, you have to nod. And the fact is, it's not really true, with all due respect to the poor, young 26-year-old couple trying to buy a house at $477,000. I know how awful that must be. But let's look at some data and let's look at some history to see it in context. Okay, this right here, we did a bunch of data to look at comparing the average Denver per capita income, average Denver home price, and the average annual mortgage rate to find what lenders call a DTI, a debt to income ratio. So when you get a loan, they're going to get you a DTI, and your DTI better be relatively low or you can't get a loan. And by no coincidence, there's that 40 to 45% DTI that lenders look for. So let's look at historically what we see in Denver. In 1971, by our calculations, the average DTI was about 40%. It skyrocketed in the 80s. Why? Because interest rates went up. That means that it was very, very difficult to buy a home. And indeed, what happened is people didn't buy homes in the 80s because it took a very, very high, DTIs went up so high that they couldn't get loans, and there was all sorts of different ways of getting loans, but it completely affected the market. What this means here is homes were very unaffordable. This right here was sort of average affordability, and our little dotted line is our best call at what the average has been over this period of time. So this is about average affordability, tremendously unaffordable. Then you have interest rates go down, down, down over about a decade, and homes become roughly affordable. This is a proxy for an affordability index. And what you say is it stayed in the 50-ish% for this period of time. So now let's talk more like present day. What happened during this period of time? Prices collapsed. It wasn't that interest rates went down or people suddenly made more money. Prices collapsed. So what's important to understand is that we had, at one point, a 30% and even lower average debt to income for Denver Metro. What that means is this, in retrospect, was the perfect time to buy. Homes were incredibly affordable. So when you read the Denver Post and they say that homes are unaffordable, they're right compared to this period of time when homes were the most affordable they've ever been in Denver history. They're wrong compared to this. Homes were much less affordable here. So it's correct to say that homes are less affordable than they were 4 or 5 years ago. Of course it's correct. Of course homes are less affordable. The question, though, is, are they unaffordable? And the market is telling us they're not. We have more buyers than sellers. That means that there are more buyers and sellers, that people are still paying the prices. So this right here is the latest data. This is 2017 right here. And what we're seeing is that absolutely prices have gone up, homes have become less affordable, and we're getting past this 40 to 50 year average. And what I will tell you is that if you check back in a quarter or a year or 3 years and we're here, of course I'm going to say, yeah, homes are getting to the point of unaffordability and things have to change. What's important, though, is to understand the context. And the context is we are still close to the average affordability. But I promise I will, once again, bet a cup of coffee that homes are going to continue to become less affordable. Why? Because wages aren't keeping up with prices. That's exactly what's going up. And, of course, if interest rates go up, it'll even make it stronger that affordability will go down. So I would expect this line to continue going up. One could argue then, if you're, say, Michelle, and you're an agent working with some buyers, you might show this to your buyers and say, well, where do you think this is going? And I think most buyers are going to say, I think homes are going to get less affordable. And then you might say, right, so you want to buy today, you want to buy in 2 years. You know, I mean, that's kind of how I look at it, and that's why I just bought some more properties, because I think homes are going to get less affordable based on everything I know. Hopefully that made sense. If you have any questions on that or anything else, just jump in with questions. Meantime, we'll go to the next slide. Okay, so I'm going to build an argument here over the next couple of slides. Let me start with this one. Oh, we have a question. Hi, Kim. Hi, Charles. Won't the line always hit a cap due to lending restrictions on DTI, i.e. lenders probably will never lend at 80 DTI again as in the 70s? Oh, that's a good question. Yes. Now, I wasn't around here in the 80s. And yes, there should be a cap, but I don't think it's like an exact cap. It's sort of a kind of a cap. Like, lending is going to get much more difficult, of course, when people can't afford it, just like it did here. But do you know how many closings we had in like 1981 in Denver? I can show you a couple of slides ago. We had 4,000 a month. Amazingly, somehow they figured it out. They were doing wraps. There was FHAs and HUD properties. People were still buying properties. So what I would say is a cap isn't the right word, because that sounds like a black and white. Like suddenly no one will ever buy a home again. Just go back to the 80s, talk to people who bought here, and they'll tell you, no, people still bought homes. I can go back 3 or 4 slides. You see people still bought homes. What it will mean, though, is that clearly it will be more difficult to get loans, which means it's less affordable, which means that over time it might do, you know, something like this, and then we kind of hit that cap, and then it gets like kind of rocky, and then maybe it'll have to go down in the next decade. That's the way I would look at it. And HUD homes, yeah, Matt brought up HUD homes. Tons and tons of HUD homes were selling. And then, of course, you could assume the loan on HUD homes as well. Very creative times back then. Talk to some of the old folks. They'll tell you all about that. So while I agree with the spirit of what you're saying, Kim, cap isn't the right word. It's more like it'll get more difficult and then things will change the following decade. That's what I see going on here. Thanks for that. So what we see here is a guess, speculation on what we think is going to happen to the population of Metro Denver. So I don't know about you, but I'm not from Metro Denver. I'm from Boston. Beautiful place to live. I don't want to live there. I live in Denver. It's pretty much what everybody says when they move to Denver is they don't want to leave. There's lots of good things going on in Denver. So Patty Silverstein, she's a demographer and really well-known economist in Denver. These are her numbers, but she believes that we will add something like 45,000 people to the Front Range per year for the next 10 years. The purple is natural increase, which is a nice way of saying births over deaths, so more people are being born than die. And then this is incoming versus outgoing. Now, if you look at data here, what you see is we had some downturns. 2003, 2005, we actually had net migration out of the Front Range. It can happen. I know I had 29 units then. It was kind of tough to rent them. That can happen. But her best guess is that we're going to add people. And of course, that's what's been happening the last few years, adding lots of people. And that has been putting a lot of pressure on housing. So the second part of the argument is looking at Denver construction trends. And what this shows, going back to 1982, is these are the permits that were pulled for two different types of properties. These are for sale properties, properties people buy, and the black are for lease properties. And what you see, and I'm going to put it all together in the next slide, is that we had very little building going on during the downturn. We have lots more building now, but you'll also see that a whole bunch of that building is for lease, and a whole bunch of that for lease stuff is larger, well, not larger, but more expensive, tending to be downtown units. We have lots. Look at this. Look how little for lease stuff was built during these periods of time versus now. But the subject of this webinar is really for sale stuff. And what you're seeing is we seem to be having sort of a cap on the number of permits being pulled for just homes that people can buy. So let's put it all together. This right here was from the Denver Post. They came out with an article early February of 18, and it was a great article. I really give them tons of kudos, enough kudos that I'm stealing it and I'm citing them to say thank you, Denver Post. And what they talk about here is the housing gap. They put it in a great way. This is the Denver area, says the Denver area has been adding households at a higher rate than housing units for a decade. Okay, so this right here, I wish they had had different colors, but this bar is the number of households added in 2001. This bar is the number of housing units. So obviously, if you have more housing units than households added, then you're not really going to have a housing crisis because you have tons of units. This is what happened over this period of time. But look what happened here. We added 21,575 more households than housing units in this 1 year. We did it again, and we did it here, and we did it here, and we did it here, and we did it here. What we're saying, what the Denver Post is saying, which I agree with, is a summing up the previous two slides. We have more people moving into Denver, and we do not have a corresponding number of housing units being built. And even if 2016 was equal, we still have this housing deficiency. We have years of housing deficiency where you have all of these people here moving here, and we have very little supply coming on the market. And that's how I tie in all of these slides. Every slide is saying the same thing. We have more demand, people who want to live in Denver, than we have supply. And if you're a housing advocate, this is a big problem. I work with Mercy Housing and the Mile High United Way, and Your Castle is a big donor to those organizations, and I'm on a board with them, and we're actually, working to sort of help this. The flip side of the coin is we have a serious housing crisis in Denver. So if you're an investor, you might be saying, oh, the market's going to collapse. Well, most of the world doesn't believe that. we have a housing crisis where people cannot find homes to live in. And this is the perfect explanation and visual to explain why people can't find homes to live in. And as an investor, well, this is why I buy properties in a market where there isn't enough supply for them. And so far, so good. Hopefully that makes sense. Email in if you have any questions. Or, I'm sorry, type in if you haven't.
Somebody lost audio.
Okay, so we got a lost audio from Tony. And we actually have, okay, he's back. Okay, that's good, because we actually have Channing here also monitoring audio, because, you know, we're getting pretty good at this, and he had the audio. If you lose it again, or if anybody else does, let me know. Thanks for that. So here's a great slide that I am going to credit Mr. Travis Spear from Pine Financial. We were just sitting around, I think after one of our Investor Success Summits, drinking a couple of beers, and he's like, you know, it would be a great slide. Why don't you do home prices versus median rent? And I said, damn, that would be a great slide. So here's what it is. From 1970 to present day, I tell you, you can't make stuff like this up. Home prices, that should look very familiar. That's literally the slide we showed earlier in the presentation. And then this right here is the median rent. And yes, there should be a correspondence between the two, unless people leave. And the fact is, in other cities, less, say, desirable to live in cities, people might just leave, especially if they don't own a home and they're not stuck. And that might affect it. But Denver's not a place that people like to leave. People love Denver. Our population is going to continue to go up. And what you see is somehow they make it work. And isn't that interesting? That the rents have gone up at the exact same angle as home prices have gone up. And that's exactly what we're seeing today. And see, Ellen, you got a great question. Great last chart. Is it available in our booklet? Yes. And Ellen, definitely give me a call today. I know we chatted for about 12 seconds yesterday, but just give me a call and let's catch up and I'll get you everything you need on these charts. Happy to help with that. All right, just one or two slides left. Let's look at the investor stuff. This is kind of the segue, talking about median rents having gone up. Let's look at it a little bit more in depth. This is Apartment Association of Metro Denver, terrific data. This is their 5+ unit complex data. And what we're looking at here is the vacancy rate by quarter over the median rent by quarter.
Can you zoom in on that one a little bit?
Yeah, absolutely.
That's better, yeah.
Okay. And we have a question. What size rental are you using for average rent price being $1,200? Where do we say $1,200? So I'm not using it. So this is first of all, this is Apartment Association of Metro Denver. Secondly, if you want their like 60 or 70 page recent report, I'm happy to give it to you. Like, you know, just want to share it with you. So I'm not 100% sure, but this is basically their average rent by quarter. So I assume it's all of the data they have put together. So let me know, send me an email, I'll send you the most recent, and then you can look into it. It's a detailed question that I'd have to look into, but all I can say is they add up all of their data and divide it, you know, all of their rents divided by the number of units, and that's what they're coming at here. Oh, previous chart, he's saying. Well, interestingly, look at this, it's about the same, right? 12 or 1300. So I think we did the exact same thing. I actually think it's that way because we're using the Apartment Association of Metro Denver data. Hold on one second. Can you grab this and just see what he's called me like 5 times, my son. Just make sure it's not an emergency. So yeah, I think we're all using the Apartment Association of Metro Denver.
Channing, your dad.
So if we look here, what we see over time is that when we have very high vacancy rates, sorry, Channing, try again. When we have very high vacancy rate in the 80s, what you see is that median rents just curtail. Basically, they go down a little bit and they stay flat. And then when we have periods of time where vacancy rates are low, and this is like a 10-year period of time here, what you see is median rents go up. And once again, perspective, it doesn't happen every day or week or month. These are like 10-year periods. High vacancy rate, low rents. Low vacancy rate, a decade of skyrocketing rents. Thank you. Then we have this right here where vacancy rates go up, and whoop, you see right about there, all of a sudden, rents are flat. And they're almost literally flat for 12, 13 years. So I started buying right about here. So I had like, you know, 2 good years. And then nobody mentioned to me that I'd have flat rents for 12 years, but that's what happened because we had a really, really tight vacancy right here. Tough times for landlords. But over time, things corrected over this long period of time. And then you see these low vacancies going back to 2010, 2011. And what's the result of that? Skyrocketing rents. So rents really started taking off around 2012, skyrocketed here to 2015, 2016. And what we're seeing is, rents basically not leveling off, but not going up at this angle. This was a great angle for landlords. It started to smooth out a little bit. My best guess is that's exactly what's going to happen. We might go back towards long-term average, which has been about 4% per year. That's what we talk about right here. And then Tony says, what booklet? Yeah, sorry. The booklet I'm talking about is the Apartment Association of Metro Denver. And I know it's really tight right here, but we cite Apartment Association of Metro Denver. It's their data, and they come out with a quarterly chart. And if you send me an email, I'd be happy. I'm sorry, a quarterly report. It's a really thick, incredibly data-centric report where what they do is they just send out quarterly surveys to all the landlords, and they get a really, really good response rate in Metro Denver. They're the godfather of all the numbers. So if you want the latest one, I'd be happy to send that over to you. So this tells you a couple things, that things happen in, at least historically, in roughly 10-year periods. Not exactly, doesn't mean something's going to happen in the next year or two. It just means it doesn't change every week or every month or every time you read a Zillow article, something changes. Things tend to move in long periods of time. Kim asks, can you speak to how this looks for single family or less than 5-unit multifamily? Yes, I certainly can. So the reason I put the multi here is because they only started doing the single families, the 1 to 4 units, I should say, about 5 years ago. So we have the data for single families, but it's so important to see the history of it. One thing I will tell you is that apartment rents in the multi-units, 5+, are always higher. So for example, I'm sorry, I said rents, I meant vacancy rates. So right now, it's at about 5.5%, maybe 6%. Vacancy rate in the multi-units 5+. It's more like 3% in the 1 to 4 unit. For whatever reason, 1 to 4 unit properties have statistically lower vacancy rates. But they move in tandem. Essentially, they are a related market. So when one goes up, the other one will go up, and vice versa, they'll go down. Vacancy rates will move in tandem and rents will move in tandem. Just what you see is that vacancy rates are lower in 1 to 4 units. Hopefully that helps you out. And if you want to look, like I said, at the source data, just let me know. I'll send you over the apartment association stuff. And then here's the last slide. Here's what I want to talk about. I'm going to skip these two here because it's a little hard on a webinar. I want to just kind of get to the payoff pitch right here, which is this. This looks at the rent as a percentage of per capita income. So the higher the rent is as a percentage of income, the less affordable rent is. That makes sense? So in the 80s, for example, rents were very, very unaffordable. Kind of that DTI we were talking about a few slides ago. Rents were taking, on average, 30% of income. Then it went down, then it went up, and then it went down for a long period of time. And this right here, as a landlord, sucked. This is when it was very tough to be a landlord because we were getting more like 20% of per capita income. So similar to how we talked a couple of slides ago in debt to income ratio and affordability, what you hear constantly in Denver is that rents are unaffordable. And yet, put something on Craigslist. I just bought a property a few weeks ago. I put it on Craigslist. I rented it. Life was good as a landlord. There are more renters than there are landlords. How do I explain that? One, if I wanted to convince you that rentals are unaffordable, well, I would just show you the last 5 or 6 years and not show you history. I'd say, of course they're unaffordable. Look at that. They're so much less affordable than they were here. But the truth is, this is record affordability. This is as affordable as it's ever gotten to rent. So if we compare it to that, absolutely, rents have got up. Absolutely, wages have not kept up. And by the way, in our most recent 2017, end of 2017 data, we're now past what we consider the 40-year average. Rents are becoming truly unaffordable historically. If this continues to go up, it can't go up forever. The last time it went to 30%. Can it go that high? I mean, I don't know. Will it go to 35? Will it go to 25? I don't know. All I can say is that monitor this, and that rents, my guess, just like I said here, are going to probably have to start smoothing out so that wages can catch up. That to me makes perfect sense. Rents aren't doing this anymore. They're flattening out a bit so that wages can catch up. My guess is this will go up for a while and then have to start flattening out as rents truly become unaffordable. And then they'll start potentially doing this and maybe coming down during the next cycle. Matt has a question. Have you done any research into the short-term rental market, Airbnb? So your castle really hasn't, mostly because, as you probably know, you can't legally rent a short-term rental, except with a couple of weird exceptions, if you don't live in the property. But I do know, a reasonable amount about it, and I know lots of people who do it. So if you want me to turn you on to a couple of people who do it, who might be able to answer some more questions, I'd be happy to do that. But it's not something we overly want to promote, because the fact is the Denver City Council about 9 months, a year ago, finally said, okay, you have to actually live there. You have to live there. One interesting exception is, let's say you're living in a house and you're the tenant. You are renting a house from a landlord. So you're the tenant. You actually can short-term rental your place because you're living there. So there's been this whole sort of group of people who have been trying to figure that out, saying, okay, so I have a duplex. I will, finger quote, rent it to my friend, have a lease. My friend will, figure quote, rent it, short-term rentals. So that's not something we want to get into, certainly not from a corporate perspective, but yeah, you might want to look into it more. Go to the ICOR meetings or give me a call. Happy to chat with you and point you in some directions. So with that, we have reached minute 48 here and gone through the slides. I'll give you a second if you have any questions, want to throw anything out at me. I appreciate your time. Always love when not one attendee actually checked out early, so that just makes me feel good. Thank you so much for your attention and attentiveness and great questions. If you don't have any more questions, I'll give it a couple more seconds. You can always reach me, C Roberts, the letter C, ROBERTS, at yourcastle.org. Email me any questions. If there's anything we can do for you, please let us know. Channing, anything else we need to do?
Nope, I think we're good.
Okay. Well, thanks, everybody. Appreciate your time.